Hi and welcome back. In today's video, we'll be covering private mortgage insurance or PMI. So let's get started. What is private mortgage insurance? So private mortgage insurance or PMI is an insurance product that protects the loan company and not the homeowner. It essentially covers the lender in case the homeowner does not make their mortgage payments. Just as a quick note that having private mortgage insurance does not protect you from a foreclosure. Are you required to have it? Generally, if you have a conventional loan in which you paid less than 20% down as a down payment, then yes, you have PMI. Note that I am talking about a conventional loan, and this actually differs for FHA, USDA, and VA loans. So is PMI the same as homeowners insurance? No, they are not the same. Homeowners insurance covers your home in case it gets damaged. Again, PMI covers in case you default on paying the loan, and it doesn't go towards you, the homeowner, it goes towards the loan grantor. Are there different types of PMI? So there's two types, and it's all dependent on who's paying for it. Borrower paid private mortgage insurance is paid by the borrower, and therefore it is usually tied in with your mortgage payments. Lender paid private mortgage insurance is paid in full by the mortgage lender, and generally it is paid at the closing cost, and the homeowner accepts a higher interest rate for the entirety of the loan instead. Can PMI be canceled? Yes, but it depends on your loan service provider. So it is automatically canceled once you hit 22% equity in your home, meaning that you have paid off 22% of the home's value at the time of the loan being taken out. In some cases, it might be tied to a time frame, in which case you generally have about 2 years of payments of PMI before they are willing to allow you to pull it. Remember that this is again based on conventional loan. Another way to potentially get your PMI canceled sooner is to get a new appraisal on your house if you believe that your house's value has gone up since the time that you purchased it. If that is the case, it could change the rate of equity that you have within your home, and if you meet that 20% criteria, then in general you should be able to cancel it if you notify the loan company as well as the PMI that you have reached and satisfied that 20% minimum. Again, it is automatically canceled at 22%, but some people like to cancel it a little earlier to save more money. How much does PMI cost? Well, that kind of depends also on the value of your house, but also interest rates change on a daily basis. So it is roughly 2% of the total loan balance at the time that it is purchased and then continuous. So what determines the PMI cost? So a lot of factors come into play, but there are essentially only two factors that you actually have control of. The two factors that you have control of is your credit score at the time of purchasing the house and the amount that you put down as a down payment. Essentially, you need to note that the down payment percentage is equivalent to the equity percentage you have of the house at time of purchase. Other factors are simply the price of the home, as well as what type of mortgage loan are you getting? Is it a fixed rate or an adjustable rate? Does PMI change? Yes, it does. It actually gets calculated on a yearly basis, because if you are paying your loan on time, then your balance is going down. So again, it's roughly up to 2% of the balance per year. And so as your balance goes down, so does the cost for PMI. So yeah, that's the basics on PMI. If you have any questions, please leave a comment below. More than happy to answer. Thanks so much for subscribing, and if you haven't, please subscribe. Also, if you have a friend who doesn't know what these things mean, send them this video so that way we can continue sharing information. So that's all I have for you today, and I'll see you in the next one. Bye!